we have Jeff Wergler, who's here and is going to address and present a paper that he has worked on, Financing the Response to Climate Change, the Pricing and Ownership of U.S. Green Bonds. Jeff is the Nomura Professor of Finance at NYU Stern School of Business. His research and teaching interests include corporate finance and behavioral finance. Before joining Stern in 2001, Professor Wergler was the Robert B. and Candace J. Haas Assistant Professor of Corporate Finance at Yale School of Management. He has also been a visiting professor at the University of Oxford, Said Business School. Professor Wergler received a Bachelor of Arts and Sciences degree from Stanford and a PhD in Business Economics from Harvard University. While at Stanford, although it's not as in bio, he apparently was on a football team that thrashed Dan Bergstresser's team. He's humble about that. Dan is still stinging, but somehow they managed to come together and work on this research together. So I just wanted to note the hurdles that people go through to get research here, and we really applaud them overcoming some of those personal hurdles. That's right, very civilly, they've come together here for this research. All right, welcome, Jeff.
So this is a paper with Malcolm Baker, the ubiquitous Dan Bergstresser, and George Serafine from HBS. It's fair to say that with respect to climate change, there is no good news. 16 of the last 17 years are the warmest since worldwide record-keeping began, or data are available. I just checked, it's 103 degrees, the high temperature today in your hometown, Dan, and it's 107 later this week. So this sort of extraordinary weather event, which is increasingly less extraordinary in the case of Dallas or many other cities around the world, is the sort of thing that we need to deal with, and the consequences are already apparent in rising sea levels, retreating glaciers, economically damaging weather events, flooding, droughts, storms, and the like. What are we going to do about this? In the absence of some significant global, carbon tax that doesn't seem to be coming anytime soon, perhaps the financial markets will play a role in order to keep us from scientifically estimated catastrophe. We need to keep global temperatures below 2 degrees Celsius over some long-term average, and a crude estimate, obviously, hopefully within an order of magnitude, being correct, we need about $12 trillion over the next couple decades to mitigate and adapt to this change. So how can capital markets play a role? There's a category of fixed income now called green bonds. Green bonds are bonds defined by their use of proceeds, which exclusively support some sort of environmentally sensitive purpose. This can be anything from biodiversity conservation to clean energy, or safe water supplies, and the like. I'll show you the categories of uses of proceeds for green bonds in a minute. So this is a growing market with many markers of maturity. There are indexes, ETFs, actively managed green bond funds these days. I'll tell you a little bit about the history of the market in a moment. There are many categories of issuers in this paper, and obviously relevant to this conference, why we submitted it. There's a lot to say, and the best data are in the US involve the municipal bond market. But issuers of green bonds also include supranationals, some corporations around the world, universities, and country governments. And from an academic perspective, this has some advantages relative to the stock market in terms of being able to say something about prices. How are these bonds priced relative to ordinary bonds? In the stock market, the level of prices is a very difficult thing to measure. We can estimate average returns over many, many years, and we still don't have a good sense of what true expected returns are. At least in the bond market, we have the yield at issue. Well, that's not a perfect measure of prices, but it's much, much better than what we have in the stock market. So if we're going to take a more academic view of just talking about what is the impact of investor taste on prices of securities, this is a relatively good setting for looking at that. So there's a sort of fixed income market analog to the SIN stocks literature, ESG, SRI investing literature. So some quick history of the market. This market started only 10 years ago with the first labeled green bond being issued by some supranationals there. 2010, associated with Build America Bond program, there is a kickstart to the U.S. green bond market with some federal subsidy bonds. The first labeled green bond, self-labeled green bond, self-declared, was issued by the Commonwealth of Massachusetts in 2013. The first self-labeled U.S. corporate bond was Bank of America the same year. And there are increasingly recognized market conventions for what constitute a green bond, having to do with the use of proceeds and how the proceeds are managed to guarantee that they are used properly. So that is a set of principles were developed and promulgated by investment bankers in 2014. And so on. Over the last few years, worldwide issuance of green bonds is still a small number in terms of the global fixed income market, but it's doubling every year approximately. So this paper has 3 parts. The first and majority of my minutes today, that is to say 4 minutes instead of 2 minutes for the other chunks, is going to be about the overview of an overview of the U.S. green bond market. Then we'll talk a little bit about how green bonds are priced relative to ordinary bonds. And then to what extent is ownership of green bonds concentrated relative to the ownership of ordinary bonds? That is to say, do some investors have a special preference for green bonds? And what we'll see, just to give you a preview of the results from section 2 and 3 here, is that yes, the overall story is that it appears to be the case that there's a subset of investors willing to pay a little premium to hold green bonds. And that shows up in the prices, that shows up in the patterns of ownership. So I think that's pretty intuitive. In terms of identifying green bonds, we use a Bloomberg green bond flag. Pretty simple. We decided that they're doing something of institutional quality, which is at least as good as, we would do no better, for sure. And Bloomberg recognizes the problem as there are many shades of green. This market involves self-labeling. There is no worldwide accepted definition of what a green bond is. Terminology often varies. And the bottom line is that is this bond being used 100% for some designated set of environmentally sensitive purposes? So that is about as concrete a definition as the market has come up with at the moment, and we just decided to use Bloomberg's own definition. Our sample, we have a couple U.S. corporate bonds, green bonds to analyze, but it's just such a handful that the majority of the paper is about municipal green bonds, and they come in a couple different flavors. I'll just skip those and just mention that, okay, we're using Bloomberg's definition of U.S. Municipal green bonds. So there's a line through an important column there. Panel A is the municipal U.S. green bond market. You see various indicators of how it's growing. And panel B shows that there are only a handful of U.S. corporate green bonds. And basically, look at the second to last column and the last column. That compares the volume of issuance in each year of green bonds versus non-green bonds in our emergent sample, with the requisite data to do various regressions. So you can see that even in 2016, the last year of our sample, only about 2% or so of all municipal issuance in emergent is a Bloomberg green bond, but it's rising. So what are these green bonds used for? Again, the second to last column shows the amount of proceeds for different uses and for green bonds versus ordinary bonds on the very last column. You see the numbers are small for green bonds and mostly zero for a lot of categories. It makes sense that airports cannot issue a green bond, or parking lots or things like that, but more likely to see green bonds being issued to finance public power or mass transit or more energy efficient university buildings, schools, and the like. Or clean water, some sort of sustainable clean water project is another important use of U.S. Municipal green bonds. What are the characteristics of green bonds? There's a lot of numbers on this table. I'll skip them. Green bonds are slightly larger than average at the CUSIP level, slightly longer maturity, more likely to be federally taxable. That's as a result of the early green bond programs in 2010, 2011, 2012, 2013 to some extent. They're more likely to be revenue bonds, and naturally they're associated with specific types of projects, so that makes some sense. They're much more likely to be new money bonds. And finally, a subset of green bonds in the last row of the top panel there, a subset of them are certified in a sense by a third party and then registered with the Climate Bond Institute. And about 1 out of every 15 of the municipal bonds in our sample sort of has this extra stamp of approval in terms of having a Big Four accounting firm or some independent firm saying, yeah, this really is a green bond according to this and that definition. So giving some investors some extra confidence that they're investing in something, that is what it claims to be. So in terms of the pricing of these bonds, I'll skip, so a simple hypothesis is that, well, most of us don't care if a municipal bond is green or not. Some subset of investors cares extra, and so it may be the case that such bonds trade for a little premium, and that's what we see. So that's a natural hypothesis, and it's sort of the inverse of the sin stocks literature. Here the question is a special subset of securities that is in favor, do those go for a slight premium? And in the sin stocks literature, tobacco stocks and firearms and so on, is it the case that such stocks go for a bit of a discount because they're out of favor by some subset of investors and they therefore deliver higher returns instead of lower yields? So I'll skip those sorts of analogs and the basic yield statistics. Overall, in a broad sample, not controlling for anything, green bonds sell for a slight after-tax premium. The more interesting and compelling results are regression results. So here there are 4 specifications. There's approximately 2,000 green bond CUSIPs in our sample relative to 600-odd thousand non-green or ordinary municipal CUSIPs in our sample. And so we have 4 specifications with various types of control variables down there indicated, and a green bond flag. And so, for example, in the first specification, the after-tax yield of the average green bond in the sample is controlling for various factors, about 7 basis points per year lower than an ordinary bond. For the subset of green bonds that is externally certified, that number about triples because such bonds are both green and getting a flag for the top row and getting this CBI certified flag here. So it's the sum of those effects that are associated with the prices of certified green bonds. So that is in contrast to maybe the sum of those two effects is equivalent to reducing the risk of an investment grade municipal bond by about 2 ratings notches. So that's what a 25 basis point pricing advantage amounts to. And so it doesn't really matter what sort of control variables you're using. Qualitatively, the associations are similar across specifications. In terms of ownership concentration, so if there is a slight premium for green bonds, it would make sense that, well, this has to be driven by something, and our ownership concentration results, which I'll skip in the interest of time, just show us that indeed green bonds are disproportionately held by a subset of investors. There's less uniform, just holding these bonds in market weights, and a subset of investors, often with some sort of green or environmentally sensitive or Calvert or socially responsible investment association in the name. So those sorts of funds are disproportionately holding green bonds. So they're being held by the sorts of investors that one would expect. So just to sum up, I've given you the briefest of overviews of this developing, interesting market, increasingly important. Green bonds sell at a premium, and green bonds are more closely held or held in greater concentration than the average bond. Thanks.
Okay, our discussant for this paper is Tim Coffin, a true practitioner's practitioner. Senior Vice President, he's a consultant and relations manager and director of sustainability at Breckenridge Capital Advisors. In his role, Tim focuses on developing the firm's institutional relationships. In his time at the firm, Tim has helped lead the introduction of Breckenridge's environmental, social, and governance capabilities to clients. He's been with the firm since 2012 and has over 21 years of fixed income experience. Prior to Breckenridge, Tim was a vice president at Fidelity Investments, where he launched and managed the firm's municipal finance group within capital markets, where he managed the sale and marketing teams and served his last 3 years as the firm's president. Tim started his career in fixed income and institutional sales at DLJ and RBC Dane Rauscher. Tim serves on the governing board for Ridley College and is a member of the Municipal Fiscal Health Working Group for the Lincoln Institute of Land Policy. Tim received a BA from Hobart College and currently holds a Series 65 license. And before we get to Tim, I heard a sentence, and if the press is in the room, take note. I believe I heard Jeff say, I've never heard this sentence before as it relates to the U.S. municipals, that the U.S. municipal bond market offers the best information. So if there's a headline to print, you can take that out of the conference here. Maybe Tim will discuss that further. All right, Tim.
Thanks, Pete.
Welcome.
Thank you. You want to do something here? Hi, everybody. I don't have slides, so we're going to get a blank screen, I think. And I wasn't the president of Fidelity. There was a little misprint. I'd still be here if I was, though. Right. If I was the president of Fidelity, I'd still be here. But thank you very much for including me. And so I'm going to try and give about 10 minutes of discussions from the practitioner's point of view. So I think it's important a little bit to just frame who I am and who I represent and what my practitioner's viewpoint comes from. So Breckenridge is a fixed income investment manager. We're an independent firm in Boston. We manage about $36 billion in assets, and a little over $31 billion of that is in municipal bond portfolios. And just to put that in perspective, that means that we are actively buying around 400 million bonds a week, $400 million worth of bonds a week, up and down the curve in the municipal bond market. So we don't manage any bond funds, we don't manage any green bond funds, but we are a leader integrating sustainability, the materiality of environmental, social, and governance metrics into our credit research on both corporate credit and municipal credit. And so I do think I have good perspective on this, because many times when we go in to talk to prospective clients and talk about how we integrate sustainability into our credit research, they say, is this a green bond product? And which I think is a great segue into trying to offer some feedback or perspective on the paper. And that is that there is indeed what I would call a green bond inquiry in the market right now. There is demand for green bonds. So I want to try and follow the same 3 chapters of Jeff, which is an overview of the green bond market kind of from our perspective and how that relates to, which is very consistent with yours. Discuss a little bit the pricing of green bonds and maybe a few suggestions from that standpoint, and then also the ownership concentration. And I don't really have any strong conflict with any of the observations that you made. I think your hypotheses and your predictions were something that anecdotally everybody kind of recognized. I would just say that it's interesting, there's a Credit Suisse does an environmental finance conference every year in New York, and I always get invited. And I think that's because everybody who's looking for capital market solutions to environmental issues that are out there can't help but come back to the U.S. municipal bond market. Because realistically, as we all know in the room, municipal bonds have been green since the beginning of time, right? We've been financing clean water and public transportation, efficient energy and factors like that all at the beginning. And so we've really already modeled out all of these financing solutions that will ultimately be employed, hopefully on a more scalable level, to address many of the capital projects that are going to be needed to address environmental issues and social issues and factors like that. So the paper does, I think the sample, as you pointed out, Jeff, is over 2,000 municipal credits and only, I think, 19 corporate credits. And so I'm going to speak mostly from the municipal standpoint as well. And also highlights that environmental utilities and power supply tend to be some of the bigger issuers, and that only, I got to look at my notes here, I'm sorry, a smaller percentage were actually, 14% of the green bonds were GOs versus a little over 46% were actually enterprise revenue bonds. And I think that's an interesting thing that, and I'll just give you some kind of reflections on that. First of all, I think it's very easy for, not easy, but easier for public utilities and energy bonds to arrange green finance, because if you're ever creating energy efficiency, what you're doing is you're creating a savings, and therefore you're creating a receivable, and that bankers can therefore bond against that. And that's a model that's already been proven out. I think the interesting observation that only less than 15% of municipal bonds or GO bonds, general obligation bonds, or green bonds, speaks a great deal as to the challenges that green finance faces. And that is, when a municipal credit analyst looks at municipal credit, one of the first questions they ask is, what are they using the money for? How essential is the public purpose? And I think when Marty Walsh, the mayor of Boston, comes out and says we need to build a $10 billion seawall, okay, clearly that's going to be financed in the capital markets. They're not going to do that. They're not going to have a bake sale to raise that money. But at the same time, he politically has to make the case of essentiality to his constituents, to voters and to legislators and factors like that. And so, if you compare K through 12 education, which is largely financed through the general obligation bond market because they don't have revenues, there's a case where society has said K through 12 education is so vital to our future that we're willing to provide unlimited taxing power, our property taxes, to back this. And I think it's very important for green finance and environmental finance to start looking at this. So to take a step back, the bigger picture there is banking green bonds is not the problem. Funding is the problem. And I think any of the issuers in the room would probably tell you that, right? You have to go out, make the case for essentiality, figure out how you're going to, what you need to build, how you're going to pay for it, and the bankers are waiting right outside the door, as are the investors, right? It is an open inquiry. So that's just kind of the overview from the practitioner, from the Tim Coffin world. Switching on to pricing, and I think pricing is really the conversation that there's a lot of back and forth on, right? So borrowers, they want, if they're going to spend extra time or money ring fencing their proceeds or labeling their bonds as green bonds. They want to be able to demonstrate that it's actually providing them some sort of financial benefit, right? They just can't make that expense without rationalizing it. Now, when Massachusetts issued the first municipal green bond, if Colin were still in the room, he's not in the room? Didn't stay for mine. So when, oh, there he is. I'm sorry, Colin. I take that back. Thanks, Colin. Here's to BondLink. When Colin first issued mass green bonds, there were 3 or 4 series of under one general obligation bond indenture, if I'm not mistaken, and yet the green bond had more orders. It was more oversubscribed than the original series. So that right there wasn't a pricing difference, but there was a liquidity difference, and so there was a benefit to the issuer. And I think when I run into issuers asking this question, they're saying, why should we do this? Why is this necessary? All right. On the other side of that, you have underwriters and investors who have a fiduciary responsibility, not the underwriters, but investors who may be on a board or have a fiduciary responsibility where they really can't pay extra, all right? So maybe the Sierra Club can pay extra, using them as an example, but even there, you have investors who want to be able to say that we are kind of achieving our impact and aligning our investments with our mission in a way that is not sacrificing financial returns. So the paper talks about investors who are willing to do that, and I think that's a pretty small subset, and I don't think it's a scalable solution. And so the question really becomes, are green bonds worth more to mainstream investors? And I think pricing is going to be the ultimate. I think you have to keep working on pricing. And I think what's great about this paper is that it does try to normalize and control all the pricing figures they look at, especially looking at after-tax yield for consistency. What I think I would have liked to see, and I think what investors would like to see, is a little bit more kind of relative value discussion. So as opposed to kind of absolute yields. So when investors are pricing bonds, they're more often looking at them in relationship to other bonds. So you've probably heard over and over again reference to the MMD scale or the AAA scale. And for those of you who haven't heard that, municipals are often quoted at spreads over natural AAA credits, like a AAA state GO, the same way corporate credits are quoted at spreads over treasuries. And this is the municipal investor's solution to identifying relative value. So I think what would be interesting in this paper would be to start looking at some of those absolute yields you've compared and doing it based on relative to the AAA scale. Because when an investor looks at California GOs, and says those are trading 25 through AAAs, that may be perfectly normal for California, but it's not necessarily normal for Texas or Wisconsin. And so more of that relative value observation from a pricing standpoint. Another ratio that I think would help normalize over time would be that municipal investors will also look at tax-free yields as a percentage of treasuries. So you'll often hear that 5-year munis are yielding 85% of treasury yields. And that's just a way of taking a kind of a better picture of the overall relative value of the tax-exempt market versus benchmark markets like US treasuries. And so right now, where you have a very steep muni curve and you have short muni yields at a ratio of probably 60%, Steve, on the very short end of the curve, muni investors are saying, from a relative value standpoint, the short end of the muni market looks very expensive. And so if you can try and work those types of ratios into your kind of pricing discussion, I think it becomes more useful for investors and for borrowers, because they're looking at the same thing. Their bankers are coming in and saying, hey, short munis are really cheap right now to borrow, very expensive to invest in. And so I think that helps investors kind of make the case to invest in these bonds, and I think it will help issuers make the case for actually issuing these bonds. And I had another point to make about that, and I've lost my train of thought. But, I think you do make reference to new issues. I think new issues are clearly a benchmark, and I would continue to do that. New issues and how bond markets clear makes a big, or how new issues clear into the market is obviously a really important. Whether or not they're ending up in the street, whether or not they're, how much of the bonds are sold. And I think some of that data can be gleaned from Emma and things like that in terms of you can actually see the trading data for the first few weeks after investing. Ultimately, I think from an underwriter standpoint, I don't think an underwriter will ever be comfortable pricing green bonds at a higher price, lower yield than conventional bonds, almost from a regulatory standpoint, right? I mean, I almost think they could be challenged from that standpoint. But if they start seeing those bonds trade in the market at a premium, all right, then all of a sudden they can rationalize it. So if they bring a bond, let's say they bring a Texas bond, a green bond at the same price as a Wisconsin green bond, and all things being equal, they go away at the same price. But in the secondary market, the green bond, the Texas green bond, is now out trading the Wisconsin bond. The yields are lower. That all of a sudden is giving firepower to the underwriter to say, I want to price the bonds. I have a reason why I'm allowed to price these bonds that are lower yield. So quickly, ownership concentration. To me, as I started out this conversation, this is just an inquiry. And so I can't help but think in the muni market that a green bond inquiry is no different than a state-specific inquiry, right? So if Franklin has a Connecticut bond fund, they're going to have greater demand for Connecticut bonds than a general market investor. And so to a certain degree, if there's enough wealth and enough taxes in Connecticut, there's going to be a premium charge for green bonds. So if Zurich Re or somebody comes out and says that they're going to dedicate $10 billion to invest specifically in green bonds, Wall Street's going to generate some green bonds. They're going to fill that inquiry. And so that, I think it actually makes very natural sense. And I think your search of actually going through and looking for names like Calvert and Catholic and things like that made great sense. It would be really interesting to see if any tax-free green bonds ended up in portfolios of tax-sheltered money. So did they end up in Norwegian pension funds and things like that? I think that would be an interesting point. Lastly, my concluding big statement is that I think one of the great benefits of this is what I think we're seeing here from an ownership concentration standpoint is investors increasingly are paying attention to how their money is used, how their investments are used. And what's very positive about this is this sense of stewardship of investing and stewardship of the capital markets. And if investors are increasingly showing demand for bonds that have constructive use in the municipal market, how might that actually translate into the equity markets or other corporate bond markets? And will investors all of a sudden say, this money, these people are only raising equity so that a VC can flip a deal. I don't want as much for that because the proceeds are not as constructive. And I think what that's doing is, I think what's positive about the green bond movement and the socially responsible investment movement as it moves closer and closer to the mainstream is that it's increasingly asking investors to pay attention to what they own. And we, as a sustainable investor, would make the case that that's very, very material to long-term investment performance as well. So, thank you.
All right. Come on up, Jeff. Show of hands. How many people have worked on a green bond deal in here? Anyone? Okay. Worked on, owned, bought? Okay. It exists. All right. Questions? Same as before. Stay away from... Yeah. Absolutely. Sorry. That's right. Absolutely.
Thank you so much for your nuanced and detailed and informed discussion. Particularly, I thought the regulatory and legal tensions comments were really interesting that we hadn't fully thought through. We had a call with the, was it the Deputy Treasurer of Massachusetts? We won't name her. But, and we talked about, what was the history of your work with green bonds and why did you issue them? And as I recall, she said, basically, well, this was just a refunding bond. We decided to just label it a green bond. So, and we didn't notice any pricing benefit, but the issue was easier to place. And so the economists among us, which was all four of us, we didn't really understand that statement. If it's easier to place, then you can place more of it at a given price. So there is, in a sense, a pricing advantage. But she didn't perceive it. It seemed to be pretty small, and that's consistent with our results, I think. In the scheme of the variability of yields at issue of municipal bonds, a couple basis points pricing advantage is lost in the noise for a given issuer. And even within a week, she informed me, you see, depending on has Dallas made a similar issue this week, then that's going to affect the pricing that I get in Massachusetts on a similar bond. So those sorts of uncontrollable random effects on the prices of individual bonds may be why you really have to look through hundreds of thousands of bonds and compare the big sample with many careful control variables, as many as we could put together, to identify a sort of robust but modest pricing advantage. So I thought some of the ways of benchmarking the pricing that we do versus how practitioners might more properly think about it, that's something we can explore further in the paper. Lost in the short discussion was how various fixed effects and interactions and time and issuer interactions help us pinpoint green bond pricing effects off yield curves at a given point in time. But I won't get into that. Definitely some interesting and useful takeaways from that discussion. And looking at aftermarket pricing, if we had better and more detailed data on aftermarket pricing, we would dive into that. And perhaps there is enough data at this point for us to at least take it.
That's the problem.
Yeah, that was our sense. So, but if we can get maybe for a subset of the bonds, say something at least, that would be interesting. But thank you again.
My pleasure.
Great. So we're a little tight on time. Lightning round. Steve.
Steve Winterstein, Wilmers Trust. Tim, I guess this is for you. I'm involved with the Municipal Impact Coalition, which is developing efforts to have a global scale ratings scoring system for ESG and green. And in my discussions, the whole sense of social return on investment, SROI, has been a repeated theme. And ultimately, I think these so-called green bonds need to demonstrate a social return on investment. And I know you and your firm do a lot of work on that. Are you seeing that enter the conversation as much as nominal spreads, the whole concept of a social return on investment?
Thanks, Steve. So the question, is really about reporting. So if we tell investors that sustainability is material to their investment, how do we report on that impact? And so maybe you've heard of the Sustainable Development Goals from the UN, and a lot of investors are now asking for that. I think that any effort to standardize kind of reporting of impact, whether it's environmental impact or social impact, will be really well received. And I don't think it necessarily should be, the impact of Breckenridge is not, is really a collective on the intentionality of our approach for investing. We don't make a decision about something like reducing carbon intensity based on the values of that. We do it based on the materiality from an investment standpoint. So we're only going to report on our strategy, whereas I think investors are increasingly asking for impact, and I think it would be better to standardize that. I know that, am I allowed to bring up other academics who aren't in the room? Bob Eccles wrote a report recently kind of trying to link SASB's materiality factors to the Sustainable Development Goals. I mean, if somebody can kind of unwind that or write that formula, I think it would be pretty valuable.
Yes.
Adele Morris, Policy Director for Climate and Energy Economics here at Brookings. When you think about impact, I think it's important to say relative to what. Certainly, clean water, there's already, federal regulation for sewage treatment and water quality. Some of the clean power projects are mandated by state level renewable portfolio standards. So some of this activity is clearly not additional to what is currently mandated by policy. So the impact is it, yes, sure, it's creating an environmental benefit, but it's not additional to what would have happened had those bonds not been issued, because they were required to be issued.
I'll say a little bit. So that's an excellent question. And among the co-authors, there was a discussion of whether to title this paper Financing Climate Change Solutions or Financing the Response to Climate Change. And I was the one with the fingers on the keyboard most recently. And so we went with the slightly weaker framing, but that may change. If we come up with an idea of how really to identify whether these bonds are just relabeled bonds that would have been issued anyway, or whether there isn't actually new projects being financed. And it's a difficult question because we don't have the counterfactual, what would have been paid for in the absence of this market. I don't think it's making green projects less likely if there are some pricing advantages to these bonds, but in the current version of the paper and in the any near-term versions, we don't have a great idea of how to distinguish between, is this just a labeling phenomenon, or is there actual new projects being undertaken as a result of the development of this market. And so if anyone has any ideas, we'd love to hear them offline or online.
I know you're trying to close this down, but I would just say that as fixed income investors, we're risk mitigators, so we look at all of like sustainability from a risk mitigation standpoint. And so I would actually kind of refer to this as financing resiliency. We want communities that are demonstrating that they're investing in their resiliency, whether it's from a social standpoint or an environmental standpoint. If it's a coastal community, what are they doing about sea level rise? If it's if it's someplace in Arizona, what are they doing about drought vulnerability and factors like that? Because those have credit implications. Financing resiliency.
And that will be the last word.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.